Yeah, probably making friends along the way and,
Yeah.
and memories, and you get that adrenaline or that endorphin, after a good workout, getting down that hill. Maybe you crash a few times, but everyone's okay.
Yeah, when you're 11 and even younger, obviously, like
Malleable,
the
right?
And the distance to fall is a lot lower, right?
That's true.
When you're 43 and you're 6'1" and you fall, it's a bigger distance, and your bones aren't as.
Yeah. So is this something you're going to do regularly? You think? Just do it every week?
There's a few of them.
Yeah.
There's a couple of them. They're all on Thursdays, so
yeah.
that'll be. There's like one more or two more maybe. I gotta get on the calendar. I gotta get that figured out yet. But
Do you feel okay yelling at other children? Like, hey!
I love to yell at other children.
Hey!
I specialize in that. So I help coach his basketball team too.
Okay.
And we do a lot of yelling.
Yeah.
And not really yelling, but just
yeah.
kind of corralling kids that have a lot of energy. When it's cold out like this, kids aren't going outside during the day as much. So
Right.
Tuesday's a good example. We practice at night, and the kids just want to run in the gym. And it's like, I get it. They're 11-year-old boys. They want to get energy out. But we still got to corral them. So, yeah, I don't have as much issue
Yeah.
getting on.
All
with
right.
that.
So, yeah, you're heading out to the ski hill tonight. This is awesome. All right. Well, I guess go to Times Zinni to get the show on the road,
Yep,
right?
let's roll.
So we're talking about quarterly market performance here and market update. Got a few charts we're going to go over, and somewhat of a look back as we've done in the past, kind of looking at the quarter that was, and then we tiptoe as far as what does that maybe mean looking forward. Yeah, sound like a plan?
Yeah, great way to tee it up because, part of this is going to be backward looking, talking about what happened, kind of why it happened, and then start to look ahead at, okay, where are we at now, and maybe add into some items of what we expect going forward.
Yeah.
The fourth quarter was tremendous for broad asset classes. Really from that kind of end of the third quarter, September 30th time period, stock markets, even the bond market, performed really quite well in this last quarter. U.S. stock market was up just over 12%, international about 10.5%. Emerging still very solid at about 8%. In bonds, you can see two bonds were up, pretty significantly. We saw the U.S. bond market was up almost 7% in the fourth quarter. That's a big move for the bond market. That's above average, and that happened all in one quarter.
Wow.
Yeah.
Yeah, so I'm seeing the only red spot commodities, just people rebalancing, real estate up. Yeah, like you say, U.S. stock market, international, all these are kind of well above average.
Yeah, commodities broadly were down on the quarter. Energy prices were down. We saw this also gets kind of baked into the inflation numbers, which was a big driver of a lot of this. If we went back to the end of the third quarter, that was about the time the Federal Reserve started declaring kind of quasi-victory on the battle against inflation. Of course, the Federal Reserve has been increasing interest rates for several months leading up to that, to help stomp out inflation. And when the data starts coming through as though it's been some successful moves as far as fighting inflation, the stock market's really kind of rallied around that because the expectation now is that rates are done increasing, and at some point there's going to be a cut in interest rates.
Yeah, be that in the spring. I know there's sort of an opportunity maybe in March, as soon as March. Maybe it's 50-50 odds is what I've been reading, but at 50-50, it might as well be September.
Yeah, I mean, in those odds and those probabilities change, of course. It's all with the data. But effectively what we saw in this last fourth quarter is that the rate cuts are expected sooner than previously expected, right? The market often moves, or really always moves, based on future expectations. And what we saw was those expectations got kind of pulled closer in time, and rates coming down typically has been good for stocks in the past.
So I'm looking at this next chart. This is the top 7 S&P. We've also got S&P sort of broadly, and then kind of another measure of S&P, it looks like.
Yeah.
So what can you tell us about this? It looks like there's 80% gain from, what is that, 7 stocks?
Yeah, the Magnificent Seven, as they've been called. So what we're looking at, this is calendar year 23, looking at the whole year, zooming out. The kind of orangish, peachish line, what we're looking at, that's the broad market for the whole year. It's up about 26%, the U.S. large market, 26%. That's quite remarkable. That 80% figure, that's if we just take a look at just that segment of the top 7 largest companies, the Magnificent Seven, those are the ones that drove a outsized proportion of the overall results, up almost 81% for just those 7 companies.
Yeah, so it seems like the story here is that the interest rate, we're looking at every month that passes, you kind of look from January, March, May, May it takes off through the summer, a little dip in November, and then kind of back to the races to the end of the year. All of that seems like it's in prep for, sort of federal, central bankers' action.
Yeah. A lot of these companies, those Magnificent Seven, it's a lot of more technology-oriented companies, right? It's the Apple, Microsoft, NVIDIA is going to be in there, right? A lot of these companies that are heavily technology-based in a lowering rate environment, when rates are coming down, interest rates are coming down, they tend to perform better. If we rewound to 2022, it was the exact opposite. Those larger companies, they're more tech-oriented. When rates were rising, their prices were really coming down quite a bit. And so some of this we saw this last year was kind of an offset or somewhat of a kind of normalization of what we saw the last couple of years.
Yeah.
Last 2023 is a great year, but if we were to look at a 2-year number, it's really quite a different picture. You had really big down year in 2022, a big up year in 23. Add it all together, and it's kind of getting back to kind of being even at this point.
Yeah, it's just interesting how much Fed policy drives market performance, especially on those those high-flying tech stocks. There's that inverse relationship. One goes up, the other goes down, maybe broadly. So I guess as we look forward into this next year with the expectation of rate cuts, do we anticipate greater performance? And then my follow-up question is, how does that play into that small cap? So as money looks for places to grow, if large is tapped out effectively, or potentially, the market looks for other opportunity.
Yeah. And there's two ways that can come about, right? You can have some of those larger companies start to slow down perhaps to kind of fit back into kind of maybe more normalized valuations, or you can have smaller companies kind of pick up more as well.
Right. So we have a breadth increase in that case.
Yeah.
As compared to just sort of an overall, what's the word, retraction? Or not quite a recession per se, but something, a pullback broadly.
Yeah, and to define that a little more, last year was what we'd consider to be pretty narrow breadth. Again, with 7 companies leading most of the market, that's what we call pretty narrow breadth. And that in the late part of the year started to revert a bit. We saw a little bit wider, kind of more broader participation. Getting into some of the small cap discussion now, that's one area where when we look at valuations, we look at performance on some of those companies. Although they've been performing and they've been positive, we still see that as an area that is still relatively attractive compared to larger companies. And that's an area that we still want to participate in. We still allocate to that segment because, again, we think from a valuations perspective and also long-term perspective, small caps do tend to do relatively well compared to large.
I've got this chart in front of me here, and we'll put it on the screen. For those of you just listening, we'll have some of this on our website on the blog page. So the 10 and 2 spread is often looked at as sort of indicators, and we talk about inversions at time within these 2 spreads. What are we looking at in this chart, and why does it matter?
Yeah, so let's take a look at these interest rates. We had two main interest rate levels on here. The purple line is the 10-year U.S. Treasury rate over time, and the orange line is the 2-year Treasury rate. And that blue shaded area is a comparison measuring the difference between the 10-year and the 2-year. The reason we do that is we look at in terms of the shape of the yield curve. It helps us describe what interest rates are doing one relative to the other. So that shaded area, what you can kind of see right away is that the shaded area, the blue, it tends to be greater than 0. What that tells us, and over time, is that that spread, that difference, investors tend to earn a higher interest with having longer-term bonds. That's a positive upward sloping yield curve because, again, you get compensated for taking on longer time periods. Now, what happened if we kind of narrow in here throughout in 2022, we saw that start to invert. And that's when we see that blue shaded area went below 0. And effectively what's happening here is the short-term interest rates, the 2-year Treasury in this case, moved higher than the 10-year Treasury.
So the yields moved higher.
Yeah.
Right. You could earn more per year by investing in a short-term 2-year than you could taking potentially the greater risk of a long-term commitment.
Yeah. And bonds can be they can be kind of difficult to grasp at times because at times we talk about interest rates going up and down, and then other times we talk about bond prices going up and down. They are generally kind of inverses of each other. If rates go up, typically bond prices are coming down. But for this exercise, we're talking about the interest rate, to your point.
Mm-hmm. Yeah. Any takeaways from this, or sort of going into 2024?
Yeah, one of the things we've seen lately, you can see in that bottom shaded section again, as the the level of the kind of the difference, the 10 versus 2-year Treasury spread, has gotten effectively closer to zero. It's closing, put it that way. What's happening is we're seeing interest rates start to kind of, the 2-year Treasury is coming down. It's coming down more than the 10-year Treasury. And that's starting to effectively create more of a normal yield curve, right? When we see this line get back above zero, that's back to having an upward sloping yield curve. This is the market, the bond market, pretty much are kind of buying into the Federal Reserve, what they're talking about. The Federal Reserve is saying inflation's coming down. We're done having a higher, elevated kind of tightening monetary policy. We're going to get back to easing at some point. And so the bond market's starting to shift in that way. Because recall, the bond market is largely controlled by the markets, by market participants. The short end of the yield curve, they're very short, the Fed funds rate is controlled by the Federal Reserve. And so the Federal Reserve is saying, starting next year, we're going to start cutting interest rates. Well, the market's buying that. They're saying, yeah, we believe you. We're going to start pricing the bond market today as though rates are going to be lower. And so we start to see rates come down, and they change at different paces, and bond prices go up. That goes back to one of our original comments here. The bond market in the fourth quarter performed very well, and it's back to this point right here. Rates came down, prices went up.
So to bring this home a little bit more, thinking through in our own client portfolios, I guess I imagine that we have kind of a mix of bonds, right? Not, again, of course, everyone's case is a little bit unique, so we're speaking broadly here. But when we're buying, do we take this into account, the sort of duration of bonds? And do we place them separately and kind of in mind for a goal, a longer-term goal or a shorter-term goal? Do we buy based on that or more based on just pure yield?
Yeah, a great question, and the answer is absolutely. When we think about dollars that are needed for the short term, so think of in terms of someone that's retired, that's taken money out of their portfolio, those we want to match up with shorter term bonds that are aligned, that they're going to come due and be available when they need them in the short term. So that's a very, I'd say, a rigid practice of making sure we have short term bonds for short term needs. Beyond that, we have other segments of the portfolio that have different time horizons, and in there is where we view it as greater flexibility to buy different types of bonds, whether it's corporates, municipals, longer term, maybe shorter term, intermediate, moving around to where we think there's more value on the yield curve. That's a good, maybe perhaps a good segue here too, because one of the things we've seen or observed over time, so let's rewind to last year, we saw interest rates peak on the short term. You could buy short-term treasuries, short-term CDs that were 5.5%. Right? There was this temptation, not across the market, to say, "Gosh, if I can get a lock in at 5 or 5.5%, why wouldn't I just go do that?" And we would say, "Yeah, we would agree with that for a segment, for those short-term needs." Other segments of the portfolio, in our view, should have other types of bonds, and the reason being is that after we hit peak interest rates for this cycle, which was during this last year, over and over again, we've observed this where moving forward, intermediate term bonds tend to actually outperform those short term bonds, even though the beginning interest rate was lower. And that goes back to the behavior of bond prices and interest rate movements. And so there are good reasons to own other types of bonds versus just always seeking the highest yield, even if it's a short term. We do think that makes sense to own for a segment, but there's also good reasons to own other types of bonds.
Let's keep going through this deck a little bit more. We talked a little bit about CDs and the kind of rate hike cycle. I think our next chapter here is around the consumer price index.
Before we get to that, though, I want to hit on
Yeah.
one more topic on that,
Yeah.
because last we were just talking about comparing different types of bonds after peak rates.
Yeah.
The other thing to think about, too, is kind of going back to some of the temptations to begin to lock in those short-term interest rates. We've seen this before, too, where stocks actually tend to perform well after peak interest rate levels.
Because if interest rates are going down, then you maybe expect the stock market to perform better, access to cheaper money, better growth opportunities.
Yeah, money's easier to borrow.
That's a great point, right? So as you hit peak, which we kind of say is around 5.5 something, Treasury CDs, and then I don't know, it hasn't gone back above that, right? That's kind of been the high water mark so far. And we don't foresee them raising higher, or at least not for long.
And there's different, and there's not just because of what can happen after those time periods, although we observe that stocks and intermediate term bonds do pretty well after peak interest rate levels, which again we saw last year. we think about too is across a portfolio, it's not just about diversifying against stock market volatility. That's an aspect. We want to make sure that we're taking a measured approach to diversifying assets and not being overexposed to any one segment or any one potential volatility or potential risk segment. The other thing too, we think about there's risks of taxes, inflation, right? These things change over time, and different types of assets, especially as it comes to inflation, can offset the impacts of inflation.
Mm-hmm. Yeah, I think you and I had a conversation a while back as we were near that kind of peak interest rates, that you're having to pay, is it income tax on those gains per year? So it's like even though you're above inflation, you have to figure in taxes because it's realized tax each year as compared to a stock, for example, which you could hold in maybe a tax advantage account, maybe not, but
yeah,
you get to sort of pick when you want to realize that potential gain.
Right, yeah. Typically bonds, unless you're buying tax-free municipal bonds, but CDs, treasuries, these are taxable throughout the years that you own them as they're distributing income to you. And so, yeah, you have a tax impact as well as an inflation impact. Whereas right on the other side, you have stocks that typically are taxed at a more favorable tax rate if you're held more than 12 months. And you can also defer the capital gains on them. You don't have to sell them. You can continue to own Apple, or you continue to own an S&P 500 index fund. You don't have to sell that in any particular year. Whereas the bonds typically are going to have that expected final maturity and income payments.
Yeah, that's such a good point that it goes beyond just sort of if you're going to own stocks or bonds, those tax implications are a big part of it.
Yeah.
Let's get into the CPI, Consumer Price Index here. We've got a chart going back to, looks like 1970, up through the year. And I guess if we kind of zoom in post-2020, we see that big spike hitting 9%.
Yeah.
And then you take the elevator up and the elevator down in this case.
Yeah, it's a good way to put it. Inflation now on a year-over-year basis, this looks at CPI, the Consumer Price Index, it's at 3.35%. That has come down a lot in terms of that rate of change. The prices are still getting more expensive, it's just they're getting more expensive at a lower rate. Sometimes I use the example of, several years ago you buy a dozen eggs and say it was $3 and then it goes to $6, right? That's a big percentage change. And then it goes from $6 to $6.50 or $6.75, right? It's still getting more expensive, just at a lower rate.
Yeah. So if we look back, 3 to 5 years, we might see that inflation is, been up 20%, something like that is the number I've kind of been going to.
Yeah.
So when we see that 3.5% inflation, that's still above the Fed's target, right? Which is 2.
They've cited 2. I think it can be a
2+.
moving target. I think the big takeaway here is that inflation has been coming down, right? The prices of things in terms of rate of change have been coming down. So I should restate that. Prices have not been coming down. The rate of change of increase. It's kind of a complex thing. And even when we write about inflation, we joke around, you have something inflation, which is something going up, and you have rate of change, and you talk about inflation going up or down. It can be kind of convoluted. But the takeaway here is that the level of inflation on a year-over-year basis is coming down. And that's why, in part, the Fed, again, is declaring somewhat victory on inflation.
Yeah, which leads us to interest rates either holding steady or potentially coming down in 2024.
Yeah.
And, potentially what do we have? It's all connected, right? Like if bonds are up, CPI is coming down, and then stock market, has a potential to kind of foresee that and position for performance.
Yeah, and one of the reasons when we hear, say, declaring victory, it's because the Fed did not trigger a recession during this rate hiking cycle, right? They've been tightening monetary policy, they've been increasing interest rates. They did that without triggering a recession up to this point, right? We can't predict what's going to happen in the coming 6 or 12 months, but up to this point, it appears as though they've been able to kind of get inflation down. They didn't upset the jobs market too much, and that's a big part why they've been able to keep increasing rates throughout this last year. But in effect, it's kind of captured what they're calling a soft landing, right?
Yeah.
A hard landing would be they raise rates, it triggered a recession, economic activity slows down, and it's kind of a reset in the economy. That hasn't happened, at least not yet.
I think about the idea that a market is not necessarily everyone believing the same thing, but it's that there's some balance, right? So if half the market thinks that there could still be a recession the other half thinks there isn't going to be one.
Mm-hmm.
That's actually probably a good spot to be, that these kind of competing ideas are keeping each other in check.
Yeah. Yeah, it's a balance, right? Every time there's a buyer, there's a seller. When we think
Right.
about a stock, pick on any company, setting aside a new stock issuance, right? If anyone's come to the market to buy, someone's going to be there to sell, and they have different expectations and different kind of goals or objectives, and so there's that balance that occurs there. And what I think gets kind of underappreciated is how little it can take to make that get out of balance.
Right.
Right? Two people show up one day, a buyer and a seller. The next day, you have 10 sellers and one buyer. Right? It doesn't necessarily mean that all shares of Apple are being traded that day. It's a very small amount. It just means that there's more sellers showing up than buyers, and that can cause the market to go down.
All right, so we've gotten a little bit of a good connection there between CPI, stocks, bonds, and interest rates broadly. I love how this is all just so connected. You know, some of this, like, it feels at the surface to be sort of like, this seems like a kind of a boring topic, but I think as we uncover these connections between, kind of, KPIs or monetary fiscal things, it's like, wow. It's not like, again, we're not trying to predict the future, but we're saying historically these things have had an impact.
Mm-hmm.
And it's important to kind of track these things.
Yeah, exactly. To that point, it's putting together the pieces of understanding what happened, how it happened, and then using history as somewhat of a guide, because history is not going to necessarily repeat. But there are some rhyming elements. When we think about valuation, we think about interest rates, we think about inflation. There's certain things that tend to hold true over time. The timing of it, right? We'd argue that people aren't investors, participants. They're not going to get the timing right with consistency all the time, and that's not the goal. The goal is not to always try to be right with it. It's to, in a sense, try to avoid being wrong, overexposed, overallocated, and that's where, when we think about managing portfolios and wealth management, that in our view is a far more successful approach.
Mm-hmm, mm-hmm. So we touched a little bit on CPI, Consumer Price Index, having how that affects the cost of eggs, or a flight or gallon gas, whatever it might be.
Mm-hmm.
We've got a chart now, consumer finances.
Yeah.
I guess I'm assuming that credit card debts are up, and that. Well, no. Let me back up here. So we're looking at the consumer balance sheet. So this is what people are owning. There's a lot of lines here. Maybe walk us through this chart a little bit more.
Let's connect some more dots.
That's it.
So think in terms of balance sheet, right? Any company, any individual has a balance sheet, right? You've got assets and you've got liabilities, typically, unless you're debt-free. And then you typically have equity, which is the leftover. We think about this in terms of a company when you're evaluating it, also in terms of an individual. In fact, a lot of times when we have planning discussions with clients, we have a page dedicated to understanding an individual's balance sheet. We don't call it that exactly, but that's an important exercise to get an idea of what is the shape of the balance sheet. What we're looking at here, though, is over time, and this gives us a snapshot now, but assets for the consumers have risen materially over the last 10 to 15 years, right? Whether it's homes, their stock portfolios, their retirement 401ks, other financial assets, right? The values of these assets have increased, and that's made for a kind of stronger kind of consumer presence, I'll call it that. And I say it's going up relative to the liabilities, which have been relatively, mortgages being the biggest liability out there, and there's also other types of revolving auto loan, student debt, but the assets relative to liabilities, broadly speaking, right? We're taking a broad swath here. We're not talking about segments, regions. The consumer balance sheet's in actually pretty good shape.
I think you brought up a good point there, just kind of laying out the math model, right? So you have equity because you have more assets than you have liability, or the value of those assets. Not that they're more, but the value of that. So it's, yes, they went up, maybe at the same rate or faster than inflation, and then your liabilities, I guess, how do we say that? Not went down, but became easier to pay is another way to say it.
Yeah, and after 10 or 15 years of low interest rates, right, you think about connecting the dots here, right, the liability side of the balance sheet has become relatively low cost, right? Individuals are able to refinance their mortgage at 3% for 30 years.
Yeah.
And so we had a period of time where you have lower interest rates, so cost of borrowing is a lot cheaper. At the same time, you have home values. Just pick on that, right? The cost of borrowing for your home went down if you refinance or bought a new home prior to rates going up. and your asset value, the house, kept going up. And so it's not necessarily bad to have liabilities or debt on appropriate types of assets. And that's an example where another way of saying it is using leverage, borrowing at 3% to buy something, a house that maybe went up at 8% for a very low cost. That was a big reason why consumer finances, consumer balance sheet has been in pretty good shape.
Yeah, so thinking through like how much equity does the consumer have at the end of the day? Now that's maybe the better way to look at it. And just sort of broadly, it's fun to look at kind of at a macro, but as we're advising clients directly, we kind of have to come up with what's left over.
Yeah.
What's there for you to live on and to, make those monthly goals.
Yeah, exactly, because over time those debts got to get paid down. And if income streams are falling off, for example, you're no longer working, you're retiring, what's the ability to service those debts, and does that still impact the plan? And so that's definitely a good analysis to go through. You mentioned credit card debt before. Credit card debt has gone up. We've noticed that, and there's some indications where individuals, consumers are increasing their, they're increasing their the use on their credit cards, which is not a great sign to see because credit card and credit card debt is not a great long-term solution for spending, but what we also find, though, too, so credit card debt's up. It crossed $1 trillion last year. It's all new highs. It got a lot of attention, but what didn't get a lot of attention, I think, is worthy of talking about is just the fact that the economy has gotten bigger, too. So credit card debt went up. The value of the economy, the amount of goods and services being produced also went up. And so what we look at, too, is the ability to service that debt, right? It's not just the raw debt amount of $1 trillion of credit card debt. Is can people, in aggregate, on average, afford to pay it? And we've seen that with the debt service ratio. That's
it seems like context is so important here. It's like, what is your what do you call it? Your debt to income. There's some ratio there, right?
Mm-hmm.
So it's that looking at just the raw number of $1 trillion, you're like, oh man, we're all going to be making late payments and the world's going to end. But if we can service that debt based on sort of an aggregate, that we're all earning more or the cost of goods are more, it kind of only makes sense.
Yeah.
That you're going to spend more. If eggs cost $3 and now they cost $6 and you got to pay that bill, put on credit card, you quickly get to $1 trillion.
Yeah.
But can you pay it down faster or can you pay it off as fast? Maybe that's the thing to look at is, maybe revolving credit. That's maybe a topic for another show, but revolving credit, like how many accounts are delinquent?
Yeah, it's a good topic to hit on at some point. On the flip side, the consumer side is the public side or the government side, and that balance sheet is not as good looking on average. That's where, speaking of trillions, right, we have $34 trillion in debt. We have the debt interest cost is rising as more and more debt has been accumulated. And so that's on the flip side. So the consumer's in good shape, the government, but again, ability to pay, capacity to pay is a big part of that here. And at this point, it's still the highest quality credit in the world. It's not like we have a concern around is the government going to go bankrupt here, but it's something that people need to be aware of, that we're aware of. Right.
So I think about just kind of that GDP to debt ratio, just as you'd have a consumer level kind of income to debt ratio, that these might be this kind of a similar way to look at things.
Yeah.
Speaking of, I don't know what we're speaking of, kind of getting into the election year.
Yeah.
Right. Government debt, 34K or trillion. That's a big number.
It's a lot of trillions.
Yeah. And so I think we always think like, the election years every 4 years or so, these big presidential ones are going to bring more volatility. When we look back on returns, maybe there's volatility, but is there any trends one way or another?
Yeah, a great question and a good segue into it is that, in short, we have not identified trends related to election cycles that are consistent and market performance. A great report study I read is, got into the discussion around investors buy companies for the long term. They buy them for what those companies are producing, right? And companies are in the business of delivering value to their shareholders and running their businesses. Politics is another arena that's separate. And politics change over time. The big thing for businesses, when you think about it, is anybody, individuals too, is when you know the playbook, when you understand what the rules are going to be, it's a lot easier to play the game. And if it's not clear on what that might be, then there's more uncertainty. It might delay businesses from making a decision. But that's the bigger thing in our mind, is that companies don't like the uncertainty part of.
Yeah.
Or I should say stock prices don't like the uncertainty. Companies too, but prices reflect that.
A company would want to know what's the cost of capital, what's the cost of money. So you're kind of looking at interest rates there. There's a little bit of sentiment, I suppose, in there, but then, there's all these good factors.
Yeah, we went back over the last 98 years of calendar years, looking at what does the stock market do on average, and what happens in an election year. To kind of just take that 1 year apart. We find if you take the simple average of the last 98 years, the simple average return of all those years, it's about 12% for the stock market. And it's positive about 73% of the time. You have a positive return. If we look at a presidential election year, there's been 24 elections in that time period, 24 data points really. Mm-hmm. The average return is right around 12%. And it's positive, a little higher, about 83% of the time. It's positive during an election year. There's been some, big down years. The last big one was 2008, but far from any election factors there. That was the great financial crisis.
Yeah, I think that I had an assumption that presidential election years had more volatility, but when I see this chart, it almost is saying that it's maybe less, or there's less of a range between the highest return and the lowest return. If I'm looking at that.
Yeah.
Yeah, that it's not black and white. I guess maybe that's the takeaway.
It's not, and to rifle off some of these numbers of positive 73% of the time too. We look at a year like, we'll pick on 2023, right? The year started out, it's hard to believe, but there was not quite a year ago we had financial concerns, right? The Signature Valley Bank and the others that went under, and we saw financial or bank stocks fall apart. Interest rates were rising. There was lots of uncertainty, right? And I bring all that up because last year the market was up 26%. And so that data point in our heads, like, wow, what a great year. That was easy. It was 26%. Well, it wasn't easy. We got there in a different path than what was expected. That's always the case. So when we look on a calendar year basis, what I think this is good for investors and as we think about too, as we sit around our investment tables, zooming out at times, right? Yeah. Zooming out to say what tends to occur and acknowledging too when the things that you can control and can't control, and certainly elections, as we think about investing, we can have opinions on them, we can have even make decisions around them, but more often than not what we find is that there's not a tight correlation between what happens in an election and what happens in the markets on a given year.
Yeah, it seems like that the question comes up of, is a Democrat or a Republican or an independent, does that make a big difference? And just kind of based on what this conversation we've just had, it's like, in our view, probably not, right? It's continue to stay invested is maybe the answer, regardless of political party or what you think they will or won't do or what will get passed or, what's the word, gridlock, if it's a split.
Yeah. Yeah, oftentimes we use the phrase, don't make short-term decisions with long-term money. And there's definitely times we want to make sure, thinking about, we mentioned before, short-term dollars, having that set aside, stable in there, because we don't want to still take on short-term risks and have uncertainty with things that we know are going to happen in the near term, like spending needs. But getting back to the elections, when we look at, a moment ago we looked at calendar years, even we look at months, so the month that the election occurred, and we look at this histogram of results and returns, whether it was a month a Republican won or a month a Democrat won or a non-election month, there's no pattern or clarity around, if this happens, then historically this happens. It's across the board. And so again, it goes back to having a plan for how we're going to be, if there's spending needs in the short term, but then also making decisions that are not just focused on just the short term with long-term money.
So our next slide up here is time in the market is more important than timing the market. Yeah. It just seems like it dovetails right into what you were just saying.
Yeah, one of my favorite slides. Yeah. It really is, because it's to that exact point, right? Trying to time things and trying to get it right. It comes back to, we have to have the right time of when to get out, when to get back in. And then what I think is not often looked at is the amount of a portfolio you're going to do it with. Because you can be exactly right when getting out and getting in, but if it's 1% of a portfolio, it's not going to move the needle. It didn't matter. Mm-hmm. But if you get it wrong and you do it with too much of a portfolio, right, you're taking on unwarranted risks, we'd argue. So getting back to this, so time in the market, more important than time in the market. Excuse me. over the last 20 years, we look at the far left side, the S&P 500 index, on average at about 10% a year over the last 20 years, right? That's about the average, 10. If you miss the top 10 days, that next bar over, what we see is that return is 5.5%. So that's missing the top 10 performance days in the stock market over a 20-year period. So 10 days over 20 years. Your return on an annualized basis was effectively cut in half. That goes back to not trying to time it and participating in long-term dollars. It's not just set it and forget it. We still want to understand valuations. We still want to understand what different opportunities in the market look like, but that to exit the market based on a short-term view with long-term dollars can be costly from an opportunity cost standpoint.
Yeah, so staying invested through the period. And I guess, like you're saying, some of that might be rebalancing into other assets that seem, more attractive, or sort of positioning them either to kind of pull them down into the short-term bucket, as time goes on, or just to sort of position them, or, like I say, rebalance in that longer term.
Yeah, exactly. We don't ever want to be in an environment or in a situation where we don't have levers to pull. So we're not saying markets won't be volatile, that we got to just sit tight, but if we get into a volatile period, whether it's election related or something else, which we just want to make sure that we have levers to pull, meaning if markets or stock markets are down, prices are down, do we have the ability to rebalance, sell things that have done well to buy things that are down on price to, again, capture what we think will be a better outcome on the other side. And so having those levers in place is important.
I'm thinking that might take us to about the end of this discussion deck. I think we've talked, certainly talked about GDP and will the Fed land the plane?
Yeah.
Seems like probably yes, be it March or September or, some point. And landing the plane doesn't mean that interest rates don't go higher. It just means that we maybe stabilize at some of these levels we're at.
Yeah, and we avoid avoid a recession.
Right.
And so that seems to be, based on what we're seeing now and research providers that we also follow, that's what we see now, is there's a greater chance of a soft landing where they continue to kind of navigate through here without triggering a recession based on their monetary policy, based on what they've been doing with interest rates. Inflation, we expect on a go forward will probably be more moderate, because again, we agree that the rate of inflation coming down in terms of rate of change, and we think that's going to continue to hold for the time being. So for this year, we don't see any inflation spikes that could be on the horizon that would be any kind of shock to the system. And so I think that'll also why we're seeing some of the stock prices kind of settling in towards the end of last year, is that some of this data information is kind of getting more, it's kind of sinking in a little more in terms of how stocks and companies are being priced.
Yeah, this has been I think a good quarterly market update. We covered a lot that sort of happened in 2023. We looked at some history, a little bit of looking forward, some kind of interest rates, made some good connections between bonds, stock, interest rates, CPI. Maybe didn't get into unemployment too much, but it seems like those numbers are kind of in line with some expectations, plus or minus.
Yeah, you're right. The employment market's stayed relatively strong throughout these last several quarters. Yeah, and if you think about where the markets are now, what we've seen after last year, it's a great time to be, and what things we're looking at now is, it's a great time to be evaluating rebalancing opportunities. Anytime after a big market movement, thinking in terms of what can be trimmed or rebalanced or adjusted in a portfolio. Equally, making sure, looking at evaluating, do we have enough of those dollars set aside for that short-term or short income segment? Again, with markets high, this is a good time. One of the things we're evaluating now is making sure we have those sufficient dollars set aside. And that can involve some rebalancing, which in our view is a healthy time to do it. We've had a big market movement. It's a good time to be evaluating some of these things.
Awesome. It was really great to do this show with you, Jason. I know you've got to be chaperone at the ski hill soon enough. So yeah, we can wrap it up here.
Yeah, been a busy day, but yeah, thanks, Ezra. This has been great.
Awesome. Thanks. Thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Be sure to consult first with a qualified financial advisor and/or a tax professional before implementing any investment strategy. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.